All right, good morning, everybody. It's Friday. We made it. So kind of muted in the overnight hours. Everybody's waiting on the job numbers. It's a real big deal today. It's going to have a direct bearing on how big the next rate hike is. They're already talking about how they can step in front of it, and they don't need to wait. They don't need to wait on every meeting before doing it. They have a phrase for it where it's called I don't have the phrase, but it's basically saying they can hit us with interest rates on the run. Um, yeah, the phrase escapes me, but they've announced that they are in a position to where they could hit us with rates without having to actually wait for each meeting before doing that. Everything is resting on this at the moment. So not much of a surprise that in the overnight hours, that's what we were looking at. I want to go to the calendar, look at the events for the day. If yours is really cluttered like this and you're finding it hard to see the events for today, just uncheck everything and turn on Econo Day event. That way you see only the economic situation for this morning. 8:30, 9:45, and 10 o'clock. The rig count isn't really going to be something that we anticipate as being impactful in the market. So, by 10 o'clock, we're basically done with any econ today, which leaves us with the possibility of having another 0 day. We had one Monday, Wednesday, Thursday, and now we have one Friday. The Thursday 0 day was because it was the end of the month. So we have not yet activated the 5 days a week 0 day options plays in the S&P, but it's coming soon. I believe it's going to be in April when this happens. So we'll have 5 expirations a week. Even for those of you who don't trade options or maybe just trade futures, this is important. It's going to affect you. The S&P is already the most precise expected move product that exists, and it's the most precise because it had 3 expirations a week for almost a decade when nothing else did. Now, other indexes have 3 expirations in a week, but they've already started working on giving the S&P 5 expirations in a week. The more expirations in a week that it has, the more accurate its expected move model is. So that's a good thing for us, right? But they're going to run it in an experimental phase. We don't know how long that phase will last. 3 expirations lasted almost a decade before they finally were done with their experimenting. And if you're thinking, well, why the hell did they wait so long? We don't know the ramifications from making these kind of changes. It's not always just so obvious as, well, we'll just add a few more expirations. It'll be fine. Don't worry about it. Yeah, well, that's not always true. That's not always true at all. And the options world has evolved significantly since, the early 70s when we started coming out with calls. So it's not something that's set in stone that never changes. It's fluid and dynamic and constantly evolving into something else. There's also been a lot of new products coming out lately, including things called the Nano. Depending on your broker, you don't have access to Nano products yet, but you will. Yeah. All right. So anyways, we're done nerding out about that. So we're looking at the 1 hour chart, and you can see that the S&P found a little bit of support on the 200 period. When it comes to the moving averages, I've used the 50 on every single chart that I've looked at. A 50 crossover on any time frame is a change in sentiment. I've used this even on a 10-second chart. It still holds, it still has that same validity. When we cross the 50, it matters. And when we get to the 200, that's another one on any time frame, it matters. So we're at the 200, it's trying to hold support. If it fails this 200, we're very likely going to go inside the box again. Now I'm on a 1 hour, so the 1 hour box would be the one that we're focused on. But if you were on any chart time frame that was looking at the 200 and it broke, then you'd want to evaluate where the downside is for that particular chart on that 200 timeline. Want to game it out like we've been doing every day. This is the most effective way to approach the market when you're trying to anticipate what could happen on the day. There's only 3 scenarios, right? It could stay sideways. It could reclaim yesterday's levels, or it could break down from here and set a new zone or a new level to the downside. So let's game out the downside first. Although I'm not necessarily bearish, it's just we've broke that 200 here on the 30-minute. We are underneath the 50, and we have a very beautiful 50-line walk going on right now. You know, it's like just simple moving average mechanics where price makes a move, pulls back and hits that moving average, then makes a move, pulls back and hits the moving average, makes a move. Well, we're getting ready to hit that moving average for a nice, consistent, persistent move to the downside. So let's game out that theory first. It's all going to be connected to the job numbers, right? So keep that in mind. Suppose everything gets really bad. What are we going to focus on? The first thing would be our own Globex low. So that would be around 45.39. Beyond that, it will be yesterday's low, 45.26. So nearly 25 points apart. If we happen to get below that level, then we'll start worrying about last week's level. I mean, there is a little bit left from Monday. It's that same zone that we've been talking about all week, 4,500. Just like we've talked about earlier in the week, we don't want to just randomly draw a line. We want to validate that line in some way. So let's go over, look at the volume profile. We're on a 10-day, 30-minute chart, and you can see that there's one last level of volume at 45.33. That's the volume that was there yesterday that we talked about. And just like we talked about yesterday, if we were to break that significant level of support, we were very likely going to make a steep, sharp drop to the downside and halt near that volume shelf of yesterday. It's really worth going back and looking at yesterday's morning briefing and kind of get an idea for that. This isn't about, haha, I told you so. It's about looking at what we discussed yesterday and getting an idea of why was it right, right? And believe me, I get it wrong often enough. When I'm wrong, I go back and ask, why was I wrong? What can I do to improve my analysis next time? That was a pretty spot on call yesterday. Why was it right? Well, volume profile is very likely to do just like we had gamed it out. So when we game it out in advance and then it does what we had anticipated, it's literally proving you right and giving you that confidence to take the trade because it's doing exactly what you thought it was going to do. Speaking of doing what it's supposed to, you can see how we hit the edge on the daily chart. We hit the edge of the weekly expected move. The trade strategy for this is we go short off the highs, we go long off the lows. Then we expect price to stay inside the box. We're not necessarily on the understanding that we would ping pong from one side to the other. I had someone ask me about that yesterday. Just because we go long off the lows doesn't necessarily mean we're going to come up all the way to the top. And the same thing in reverse. just because we hit the top doesn't necessarily mean that we're headed down to the bottom of it in the same week, right? But if we hit the edge on a Monday or a Tuesday, very often that's a perfect trade signal to take the trade in the other direction. I wouldn't do it on blind faith. A really quick glance at the NASDAQ chart this week would tell you why you wouldn't want to do that on blind faith, right? But the NASDAQ's not as accurate in its expected move as the S&P is. So scenario one, the downside play, we've gamed that out. Scenario two would be that we just go sitting right here in our own range, that we have a Globex high at 45.55, and we have yesterday's low, and this very well could be our range for the day. I don't believe that to be true, by the way. This, out of the three scenarios, this is the one that I believe the least likely to happen, right? But it's still one we want to game out. We've been really muted last night because everybody's waiting on the numbers. Well, we're going to get those numbers this morning, and then people won't be waiting anymore. Now, just like what happened yesterday, some of the numbers weren't very clear. They left us sitting in the same spot that we were at before we got the numbers. We didn't really have any clear guidance. That could absolutely happen again today, right? If it's a low number, it's going to leave the market sitting there scratching its head and trying to figure out what the hell are we supposed to do with this. But if it's really big numbers, if it's on par as it's supposed to be, all the analyst estimates are in agreement that it's supposed to be some really big numbers, then it's going to validate that confirmation of maybe the Fed won't accidentally break this economy after all, which is what the real big fear is, right? The Fed knows it's got to start raising rates aggressively to tamp down inflation. Inflation is like a self-feeding animal. It'll just keep going and going and going. You can't just let it run its course because it won't. You have to kill it. Well, just like with chemotherapy and radiation, it's poisonous to try to kill that thing. The only way you can really kill it is to tamp down on the economy. So you got to kill inflation without killing the economy. It's a really tricky thing. These job numbers come out really strong, and it's going to give a little more validation to what the Fed is saying. You know, that they say that they can do this without wrecking everything. But, you know, there's that old phrase that everybody gets scared of. Don't worry, I'm from the government and I'm here to help, right? That age old joke, right? When has the government ever gotten anything right and not managed to screw crap up? And how are we supposed to trust this monstrosity of a thing of the government to get this right and not wreck everything? So big numbers today will help ease concerns that the Fed is very likely to screw everything up. And low numbers, on the other hand, won't necessarily ease those fears or won't make everybody scared. It'll just keep everybody still sitting in that wishy-washy spot of, gosh, I don't know if I should really trust the Fed or not. Can they perform this maneuver the way that they say that they can? So just be on the lookout for that. I only think that this third scenario would be in play if it's really good numbers, right? If it's a more that wishy-washy situation, I think we're likely to leave this range. All right. So the third scenario, we talked about a downside move. We talked about sitting in the box. The third scenario would be that we leave the top of the Globex at our current high, and we begin working our way back through yesterday's price action. There is a heavy amount of resistance near Wednesday's low, which ties in with a nice pivot point from Thursday's low. That was a really good double bottom. In the failure of that was just perfect. I hope you guys got to play that. This pivot point 101, right? You set an alert at yesterday's low, for an example, and you see all morning long that we're heading in that direction. It's not like it snuck up on you and surprised you. You had all morning to see that we were moving in that direction. What did you think was going to happen when we got there? that there was going to be at least some reaction in the market. I'm not saying I knew it was going to bounce. No, but I had a really good idea that there would be a reaction there. What reaction? Well, that's where we game it out. Literally doing the same scenario that I'm doing now, but in the intraday, asking the same questions. When price gets here, what do I think can happen? One of three things. Game it out, get ready for the play, and then trade whatever it offers me. So move to the upside. We got to get through that level, 45.75. That would put us directly squarely inside of the largest amount of volume from yesterday. We're going to go look at that, by the way, and make sure that that statement is right. Past that, there's the open of yesterday, 45.88. It's a powerful institutional pivot point. Then we have the high, the RTH high of yesterday at 45.95-ish. And then the Globex high of yesterday at 46.11, basically the cog line. So let's check that volume profile on the intraday. We'll use 5-day, 5-minute charts looking at yesterday's volume profile. You can see the point of control of yesterday. This is now an untouched virgin point of control sitting around 45.80. Yeah, 45.80, 45.78, somewhere right in there. So that is where the greatest amount of volume was at yesterday. It's also where the strongest amount of resistance is going to be. This is why checking the volume profile is better than just drawing a line. I have a line drawn at yesterday's level. It's a valid level and it's a valid line. I'm going to keep that line because it's an institutional pivot point. But I absolutely would want to be aware of the volume profile and where the point of control is at. All right, so now we would have both of those. After a while, you start to get a lot of lines on the chart. Just take a moment to annotate those lines, give yourself some clarity of what that line represents. Otherwise, there's this old phrase that says if you draw enough lines, price is eventually going to hit one of them. I hate that phrase. It almost says, why bother? But it's important to draw your lines to recognize the levels that we need to be aware of. So an upside move would have to get through that POC or yesterday's Wednesday's low and then yesterday's open. So we got a lot of resistance to the upside. It absolutely could do that though, right? I don't want you to think that it's not possible to make such a move because it absolutely is. We have an ADR right now of 1.2% and we're only up 0.5% this morning. So we could easily make another 1% move from our current location and it would not be considered extreme in any way at all. Okay, and that puts us at the high of the RTH from yesterday. It's not a coincidence that those numbers line up, right? One thing that really helps when it comes with technical analysis is that you find confluence when you're doing your measurements. You know you're doing it right when it lines up with everything else. When it doesn't and you've got random lines sitting in the middle of nowhere for no damn reason, it's usually a good sign that you're doing it wrong. For a downside move, we would first have to give back that 1%. That'd get us flat. And then a good 1% to the downside. All right, so we would just measure a 1.5% move. 44.80 is around the spot we'd be looking at. It's not exactly spot on perfect because I measured a half and we're only up 0.45, but it's close. So that's the S&P. For the NASDAQ, take a look at that daily chart first. Just a little bit of perspective. We're back inside the box. The box from the early part of February, where we worked our way down, had a beautiful trend line breakover, ran it back up, and we are now back at the top of the box. This is a very large cup, and we are now working on the handle, right? The handle being where we are here. Now, cup and handles are a little odd. Sometimes you get the pullback and the handle before you even get back to the top. Other times you get through the top and then you get the handle. So, just like with other patterns, there's not just one way of one pattern, right? There's more than one way to see a cup and handle. But I really like it when the market does what it's supposed to do, right? There's that phrase, when what is supposed to happen doesn't. That can really rock the market. It's where people get caught off sides. But when the market does what it's supposed to do and everybody's in agreement, we're all seeing the same thing and we're all expecting the same thing, things work out really well. Get a nice, clean market with consistent, persistent price action. So we did completely leave the box, but as usual, we are back inside the box. It's exactly what we expected to see. It's what's supposed to happen. So it's good to see that that is what happened. We look at this on the volume profile. We are back inside the box. When we were outside of it, we had no expectation of doing anything else other than coming back inside of it, and we're back in there. We're still in a very shallow area. There is no real volume support until we get below 14,800. There is a pivot point that we already hit at 14,850, but we've hit it. We're done with it. We didn't pass through it. So, it may have a little validity to it. I wouldn't give it much weight. I wouldn't give it much trust, right? We're done with it. A downside break, I'm going to point it out while I'm still on this chart. A downside break would have a target of the point of control, 14,625. We're at 14,950. So we're talking about a significant drop to the downside. How significant? 2.25%. And if you're thinking, yeah, man, damn, that's kind of extreme. Yes, but it would be that extreme, right? If we start getting negative today in the market, that would be the kind of negative I'm looking for. It's not outside the boundaries of how far we could move either, right? Because remember, we got an ADR right now of 2.6. We could easily give back this 0.5% and still move 2.6% to the downside and be within our average daily range. That'd be more than a 3% move. Although you do got to remember it's the last day of the week. We're going into the weekend. We have the numbers coming out this morning. They could be really wishy-washy and we just don't see anything, right? So we want to game out the same scenario that we did on the S&P. That would be expectation 1, 2, and 3. Expectation 1 would be that we break yesterday's low and continue this gamut to the downside. Hitting the levels that we've already discussed to that downside move. Now, it's worth noting the volume profile on the day-to-day. There is a point of control at 15,000. That's going to be it's a two-part line. Half of that is gravity and the other half is resistance. So if we get near that line and we begin moving towards that line, price will gravitate to that line. But then it also is a resistance. So when we get there, it's going to be a struggle or a fight to get through it. To the downside, our own Globex low is underneath this volume shelf at 14,911. There's no cog line on the NASDAQ. Cog lines only exist on the S&P. So if you see that 14,911 and think, oh, cog line, nope, that's only on the ES. But there's a lot of support at our own Globex pivot point here at that 14,911. If we get below that, then our Globex low is the pivot. Yesterday's low is the next pivot. Then we start getting down into, 14,750. It's a significant level of support, at least volume support, right? Should we get past that, then we're at the point of control. So that's our downside levels. What if we do nothing? Which honestly, it's on the table that we do nothing. I just don't anticipate that that's going to be what we get, right? But it's on the table. It absolutely could happen. So we're talking about a range between yesterday's low and basically where we broke through the 200 period moving average yesterday. So 15,000. That range right there could very well be our range for the day. That would imply that we get one more break through our own Globex high, the current high that we have right now, but not much more beyond the 15,000. Now I don't anticipate that situation, but we got to game it out, right? Scenario 3 would be that we get that upside break and we start working through yesterday's levels, which also include yesterday's open at 15,100. Close enough, right? That ties in really close to yesterday's RTH high. You could look at it as a little bit of a zone, right? Like a 5 or a 10-point zone. If we happen to get through that level, then yesterday's entire high using the Globex. Now we want to measure that out and say, but is it even likely? Can we even travel that far? From our current location of being up a 0.5%, if we add 1% to that, we would be up on the day 1.5%, and that would put us into the close of Wednesday or the open of Thursday. Kind of look at it either way. So that would be a 1.5% move, but we've got an ADR of 2.5. I would say add another half. So if this is our one, we've got a half already. We'll add another half. Puts us to the high of the Globex of yesterday. Remember what I said, if you can find confluence, if you're running your measurements and it lines up with other measurements, it validates a little bit more what it is that you're looking at, right? It's not some random line in the sand. You ever drawn a trend line and then seen price just run right the hell through it like your trend line wasn't there? And then you start to doubt yourself and think, did I really draw that trend line in the right spot? Or did I draw it in the right spot and price just ran right over it anyways? And then you begin to think that maybe you're doing it wrong. When you can validate the lines that you draw, prove to yourself that, nope, you're not doing it wrong. You're doing it just the way it's supposed to. And then price runs you over anyways. You can at least say, yeah, well, I mean, at least I was doing it the way I was supposed to do it. Gold is continuing to sell off this morning with a very clear swing high, swing low pattern. Absolutely love this move this morning. Depending on how you approached it, you could see it as a bit of a megaphone pattern as well. But just use the regression line, start at the high, drag it across the screen. Nice, clear swing high, swing low, swing high, swing low. Consistent, persistent moves to the downside. Bonds, on the other hand, had an aggressive sell-off earlier this morning. That's the 10-year. Look at the 30-year, a little bit worse. The dollar kind of topped out earlier with a tweezer top pattern and then came back down inside of it. We're getting a 15-minute head and shoulders right now. It's really muted and kind of squished, but it is there. You can use the quant line tool to kind of game out that downside move. 50% is the first target and 100% is the second target. The first target lines us right up with the close, the dollar's close, which closes at 3 o'clock. Keep that in mind, right? It doesn't close when the rest of the market closes. So again, it just validates our lines. Did we measure that correctly? Is it really a head and shoulders? Is my target correct? Yep, it lines up with our pivot point. Perfect. You can see that the algos have been working itself out of the VIX all night long. That's machine logic 101 right there. Very beautiful, very clean, just absolutely perfect move. That's machine 101, right? Of course, you can't see it in the moment. You can only see it looking back, right? So through the move last night, if we were looking at that, at what point could you have started to say, oh, hey, look, the machines are in there trading the VIX? The sooner you can do that, the better, so that you can at least validate what it is that you're looking at. But that was a very controlled, clean sell off, a reduction in position sizing. On that swing high, swing low discussion, look at the NASDAQ on the 15-minute this morning. Drag your line across using that linear line drawing tool. And you can see the same swing high, swing low, very clear, very beautiful. If you right click on that line after you've drawn it, you can actually redraw it as a channel. The bonds and the dollar are decoupled. We want to make sure that they stay that way, meaning that we don't want to see the dollar begin acting like the VIX. I really don't anticipate that's happening unless we were to start getting really bearish in the market and start to see the VIX rise at the same time that we see the dollar rise. There was a number of times yesterday during that move where we saw stocks and bonds doing the same thing yesterday. That always makes me think of that commercial where it's the old ladies discussion something on Facebook, and that one lady saying, "That's not how this works. That's not how any of this works." It's kind of the way it felt yesterday, seeing stocks and bonds moving in the same direction, trying to perform technical analysis and in a correlated market state gets to be a little tricky, right? They're supposed to be divergent. Speaking of divergence, we had some very serious divergence yesterday between the NASDAQ and the S&P. It's like they each said, oh, hey, you go one way, I'll go the other. Got it. Let's do that. So it was a tricky move yesterday. It finally did sync up, which was nice because when that happened, it was game on. But, for a little while, it was a little rough trying to put those two those uncorrelated market states together. Right? Anticipate more of the same today. Let's take a look at the sectors. We normally would go over to TrendSpider or TradingView, and we still can. But I like to highlight that Thinkorswim can do these things, right? And I know that there's a lot of you who are not yet consistently profitable. Well, you want to keep your expenses down if if your trading isn't generating enough profit to allow you to go out and buy extra products, like TrendSpider and things like that. So while those are really great tools, they're not free. And if I can help you guys use one product like Thinkorswim without having to go and buy those extra products, then you can kind of keep that money in-house. Of course, they do a better job. So once you are starting to be consistently profitable in your trading, it's worth buying those tools. Just like at any other profession, tools make everything better, right? Some of the best mechanics that I know are really good mechanics because they have the right tools. Without the right tools, a carpenter can't do what a carpenter's supposed to do, right? Same thing with a trader. So the problem with Thinkorswim is it doesn't really do a good job with change percent in the pre-market. And change percent is one of the most powerful features that you have as a trader getting ready for your day, right? You want to see what's moved this morning and by how much. You want to see how many names have moved in what sector, what industry, what sub-industry, by how much. Without the ability to see change percent clearly, Thinkorswim really drops the ball on that. Of course, we can modify things and make our own stuff. I do have a slightly useful pre-market change percent, but it's not always accurate. And it comes down to what Thinkorswim recognizes as the close, right? So I had to do a little trickery to get this thing to work. And it's why I don't trust it 100%. Never trust Thinkorswim when it comes to custom indicators. It can just decide to go stupid on you for no reason. So trust but verify, like Reagan says, right? So emerging markets is up 2% this morning. For those of you who haven't heard me say that, this is my risk on global sentiment gauge. If the market globally is hesitant or fearful, they will not bid up the emerging markets in the overnight hours, right? So this would be flat or down. The fact that it's up and that it's up this much gives me a more bullish bias this morning. We still got the job numbers. So, no matter how I feel about the market, the job numbers are going to trump that. But this is a very bullish signal. Another thing worth noting is seasonality. April is typically a bullish month in the market, and the first day of April also very bullish day in the market. So, I'm not a huge fan of seasonality. It's not like I'm going to go out and trade just because of seasonality, but I'm going to keep it in mind at all times, right? Financials are also up this morning. They got a significant beatdown yesterday. And so the fact that they're up this morning is not by itself a bullish signal and not even remotely close to being bullish, right? This is linear regression at its finest. If you remember that channel that we just drew on the NASDAQ a little bit ago, and I said it was a beautiful swing high, swing low. Well, when we're at those lows, the expectation is that it turns around and goes back up. That's a part of the swing high, swing low process. Here, we've obviously swung to its lowest value plus some, right? It went way beyond its lowest value of where it should have stopped and begun to go back up. It went way past that. So just like when you see the bungee jumpers leap off the bridge and they stretch that bungee to its finest, highest, thickest point, and then it yanks them back the other way at full speed. This is the yank back at full speed, right? Linear regression coming back towards the mean. The mean would be the middle, the average. So just because the XLF is up this morning, don't look at that and think immediately bullish, right? But it is one of the two risk-on sectors, so it does matter. It is worth keeping your eye on. From my own personal point of view, though, I'm looking for a continuation to the downside in that. And I've still got my XLF hedge anyways, so let that thing crash and burn as far as I'm concerned. Technology, the other risk-on sector, significant move to the downside yesterday. We're very close to where we closed the week on Friday. We bounced off of that 200 period moving average on the 30-minute chart. And from this zoomed out perspective, we have our left shoulder and our head. We're very likely to see the right shoulder. And then, of course, we'll have the full head and shoulders, and we would measure out the downside target. It's almost inappropriate to measure the target without having the right shoulder yet. But we're looking at 150, 154 for our first target. It would take days to make that target. That's not a one-day perspective. This is another one where we expect some mean reversion. So the fact that we're up this morning by itself doesn't lend much weight to a bullish bias. Notice that I didn't use any of that language when we were talking about emerging markets, right? The EEM is up this morning, and I didn't mention linear regression, mean reversion, none of that. Because when we look at emerging markets, we seriously want to look at it like an indicator. We don't want to look at it like a candle chart. It would almost be worth plotting that thing out as a line and looking at it strictly as an indicator. Other forms of finance like KBE also up. Actually doesn't have much of a print at all this morning. Slightly up is what it shows. Then we start getting into some of the negative names, which include energy. A part of that energy move comes from that statement by the president that they're going to be releasing a controlled release every single day of 1 million barrels every day. I believe it was for 180 days. So when they start messing around with the supply on the oil, then we start to see, some trickery going on in the charts. Makes it very difficult to perform technical analysis when everything that's moving these candles are not based on the chart at the moment. Right. So you kind of approach energy with a little bit of caution. Bitcoin still moving to the downside. It looked like it was going to hold support, and then we just had that real hard, significant drop overnight, and it's still heading to the downside. It's still going. Kind of keep in mind we're getting back towards the top of a box. You could almost consider that to be a very large daily chart Busby. If 28.5 was the top of our range and we broke out of the top of that range, we're now pulling back and performing a Busby. May look to go long in here, say a healthy swing trade, maybe 4 to 6 months, using some longer dated options, uh, maybe even looking at January of next year's options. The options chain right now isn't accurate because we're not open yet. The bid ask is a little rough. But you can see that the 30 strike, January 2023, has a little bit of liquidity to it. Nothing quite as good as that until you get into June. So the June 17 series, 30 strike. Starts to look a little bit like a calendar. Would not surprise me at all if that's the trade that's on right now. The idea behind that would be that you buy the 30 for January and you sell the 30 for the June 17. Puts you in a really nice calendar position. It's kind of what I'm thinking myself. Wow, that thing's taking its sweet time this morning. Some time today, sweetheart. Get it done. All right, so we're looking at the heat map. It's set to the S&P 500, but we don't want 500 names. We want to set it into pre-market, and then we want to use the filter and knock it down off of that 500 names and get it closer to 100. It's really hard to hit 100, so 112 is close enough. So from here, we've got a pretty good perspective of what's going on this morning. We can see the FANG names are really easy. Amazon up 0.75%, Microsoft 0.5%, Google 0.75%. But Apple's flat this morning. So we got to get a little bit of assistance out of that. Nvidia's up, 1%. A lot of these FANG names, they're going to work in a group. Yeah, that FinViz Pros had heat maps for a long time. So I wonder what you mean by they added heat maps now. Did they make some change to the heat maps that they already had? Because FinViz it's had them for a long time. FinViz is a really awesome site, by the way, guys. If you can't see what I'm discussing with somebody, say you're on the live YouTube right now, somebody mentioned that FinViz has heat maps. Thinkorswim has heat maps. FinViz has heat maps. TradingView has heat maps. One of the questions that you want to ask is, do they have pre-market heat maps? Right? Um, I don't know if they do. I have FinViz Pro, but I generally don't go to FinViz in the mornings. I go to it after the market's already open. So this heat map is something that they've had for a long time, right? That's absolutely not new. But the question is, does it have pre-market? And if it doesn't, then it's no use to me at this point than Thinkorswim is, because Thinkorswim does have a heat map also, and a very valuable heat map at that. But it doesn't do me any good if it's not pre-market. But FinViz, guys, is totally awesome. There's a stock bot also that you can use that calls FinViz charts and also calls FinViz signals. It's tickers. It's you can literally ask it for upgrades, downgrades, insider buying. Every one of these boxes, you can call it with the bot. The bot for that is a free bot. It's called StockBot, and surprisingly enough, but it's worth checking out. So there you go, right? Have at it. So in the pre-market, when we're doing this work, we want to keep in mind that the S&P has financials in it, and the NASDAQ 100 does not have financials in it. So when we're looking at these two indexes, that's one of the distinguishing characteristics that we want to keep our eye on. When we're looking in here, we want to start to focus on which sectors are moving, which ones are, in a correlated state, and are they a part of those two risk-on sectors, or are they in the risk-off or the midline sectors? Peer groups matter quite a bit. So when I see a name like Bank of America, it's not just Bank of America that I want to focus on. It's the peer group of Bank of America, right? So this is just like a real quick snapshot on the morning. One thing that we're looking for constantly in the pre-market is it going to be one of those days? And by one of those days, I mean one of those days where we come into the market in a gapped up state or in a gapped down state, but we come into the market gapped. And instead of trying to close that gap, we absolutely just rip in one direction and hit one of those 2.5%, 3% moves on the day in the indexes. They're more common now since COVID because of all the volatility and the violence in the market. And we absolutely can spot these before the market opens. Right now, that was easier to validate before COVID because volatility was easier to see before COVID. Now, every day's got volatility. It makes it harder. But we absolutely can call one of those days before the bell rings. Think that through for a minute. That you're entering into the market first thing in the morning, already on a understanding that it's going to be one of those days, one of those rip your face off, absolute rocket ship, rah, one of those days. Well, you can identify that in the pre-market. Not always, and sometimes we get it wrong, right? It'll do the rug pull on us where we come into the open and we pop for the good 20 minutes and then it just dumps for the rest of the day. Of course, nothing's perfect. And since COVID, it's been harder to get this right. And there's just days where, it's flat out wrong. But it won't be like this forever. we will go back into a more normal market environment. And if you pick the skill set up now, when it is the hardest than it's ever been, when we go back to normal, normal will just be boring and easy for you. And you'll easily be able to identify when it's going to be, quote, one of those days, right? And that's what we're looking for. I'm able to call that one of those days. Last year, we had over 20 of those, and that might not sound like very much, right? You had 252 days of trading last year, and we were only able to call 20 of them. But it was 20 of those calls where we knew right at the open that it was one of those days, right? That we were able to buy 20 delta options and see 700% gains on the day across the board, which is why the Alpha Protocol list started to come out. So now we've got the NASDAQ 100 pre-market change percent. We don't need a filter because we already have 100 names. We just want to adjust the color scheme a little bit so it responds quicker to a change in market. We can see that the FANG names are well lit. Apple's not exactly moving around too good this morning, and neither is Tesla. That's not a bad thing, by the way. I don't want to approach the market after it's already moved, 2%, 3% on the day. I'd much rather get my opportunity to participate as we come into the open. So I'm glad they haven't moved too far yet. We still want to try to identify peer groups in a correlated state. When we go over to the screener, now we already know we're not going to see a lot of good numbers in here because it's the whole market's muted, waiting for the numbers to come in. We're looking at the NASDAQ, and we ask a simple question: how many names in the NASDAQ are up at least 0.5%? 38. So 38% of the NASDAQ is up this morning, 0.5%. That's not a bad number. Not aggressively bullish by any means, but it's good to see that it's on the upside instead of the downside. When we have that number, we also want to look and see, well, what names in here? What industry, what sector? Is there anything that really stands out that gets our attention? Is it the chip sector, the marijuana sector? What is it, and where does it belong? Risk on, risk off, midline. The other side of that coin would be the S&P. So how many names in the S&P are up at least 0.5%? 52. So 52% of the S&P is up at least 0.5% this morning. You want to follow that up and look at the names that are in there. I can already see a lot of automotive names in there, right? I want to identify what industry, sub-industry, and is there anybody left out? Do any of these have a red to green setup, an IX10, a trend line breakover, something off the daily chart that would give me a stronger reason to put it on my trade list this morning than just, oh, well, it's up in the pre-market? That's not good enough. I want to take that and go out to the daily chart and look for one of my trade signals, right? Those three that I just named are some of the most popular and effective trades. Certainly not all of them, right? There's Cahold, you could add that one to the list. But inside day and IX10 and trendline breakover, red to green, those are really easy to identify, easy to validate, popular enough that they're not some mythical unicorn, something that we know is good but can never find, right? So, this is just the start of that process of funneling all of those 600 names down into a manageable 2 or 3 names. I do appreciate the heads up on FinViz. One of my biggest complaints about TradingView is I can't put my watch list in this, right? So it's really limited on the things that you can run its screener on, and I just find that prohibitive. So I'll go over and take a look at FinViz and see what they have to offer, because TradingView, while it's good to look at the indexes, I've got my own watch lists that I would like to look at, and I can't bring them in here the way that I would like. So I'll certainly go check it out. I mean, I've got a pro subscription to it. I'd like to know that I'm getting my money's worth out of it, that I can find yet again another reason to use it. So I like it. A lot of times I just use TrendSpider. TrendSpider does a really good job. Um, and I've got a pro account for TrendSpider. TrendSpider's also got UOA, analyst upgrades and downgrades, blah, 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 right? All that good stuff. There's a 100,000 different ways to get your own morning briefing done, right? And the idea of these morning briefings, I'm not trying to give you a fish. I'm trying to help you learn how to fish. So absolutely take the initiative to go find things that can help you perform your morning briefing better. I love it. I absolutely love it. And thanks for sharing too, because now I'm going to go over there and check it out and see if it has what I am looking for. That's a wrap for me, guys. One little note: there's nobody scheduled to stream in the Bullish Bears today. I don't care. I'm going to stream anyways, right? I kind of just do my own thing like I always have. Um, we'll be talking futures and we'll be talking stocks and options and the marketplace. So for those of you in the pennies or in the futures room, if you want to stop by and hang out, we'd love to have you. Always looking for ways that we can that we can answer questions, help people out, maybe help you find a trade or two. I'd be interested in catching a trade or two myself this morning. So we'll look forward to seeing you guys there.